Today's handout, there are two new developments I want to point out. One of which is yesterday we learned that the jittery companies stash cash. And the first line of the news article is, stung by the financial crisis, companies are holding more cash, a greater percentage of assets in cash than any time in the past 40 years. Now, what this means is that excess cash will attempt to be invested short-term in the market. And basically, this is more fuel for the fire of the carry trade that Adam Fisher discussed in class last week for us. Where we summarize the carry trade, where it's being financed is U.S. financial institutions with excess cash willing to lend funds into the repo market on an overnight basis, creating a heck of a lot of liquidity, which is then used in turn by hedge funds or other investors to borrow the funds at a very exceedingly low interest rate. Now we have another supply source of excess cash, which is the U.S. corporations. That money has been flowing on a leverage basis into the U.S. equity market, the U.S. Fixed income markets, and moreover, it has also moved into the emerging nations, and with a side effect. And the side effect is an interesting perspective that has been pointed out by Rubini in his article last week, which attracted a great deal of attention in the Financial Times, called "The Mother of All Carry Trades Faces an Inevitable Bust." So basically, the carry trade, royally financed with the excess liquidity of U.S. financial institutions, is being used by financial leveragers to buy assets not only in the United States, but also their other favorite location for purchasing assets are the emerging nations, because the emerging nations so far have turned the corner and have progressed further and faster than the United States in economic recovery. Now, it turns out, well, the process is not unlike what we discussed before and was in the bond price exercise. If you borrow, it turns out that the dollar, being the cheapest source of money, and along with the UK probably as well, the leveragers borrow in dollars. And then if they wish to invest in the emerging nations, they convert from the dollar to the real, which is their currency, and for example. And then, having purchased the real, they turn around and purchase fixed income or equities and live on the margin of difference, all on borrowed money. Now, so far it's worked out wonderfully well because the price of the dollar keeps going down, and conversely, the price of the real is rising. So for the financial leveragers who have entered this market, they borrowed in dollars, invested in real. Now they're experiencing a capital gain in the real, as well as in a capital gain in the Brazilian securities they purchased. Now, this is wonderful while it continues. And if you have a position, and particularly an early position in the real, because there's so much more hedge fund money piling in behind you, continuing to push the currency up that you're investing in, and continuing to push upward the price of the financial securities you're investing in. He cites, for example, 70 to 80% gains by the hedge fund managers from this kind of trade. There is a problem, though. The question is, where is the end? Where is the bust behind this bubble? It has created a bubble, and we're wondering where and what would possibly give rise to the asset bubble that's being created by this excess U.S. liquidity that's fanning out across the world. What would be the pin that would prick the bubble and cause the burst of the bubble? And one possibility we talked about last week, of course, is the Federal Reserve, quote, exiting, namely causing monetary conditions in the funding country to get tight. But it turns out that what Rubini points out is there's another mechanism that could cause the carry trade to implode, and that is, as the funds are borrowed in the U.S. by the hedge fund managers, converted to real, the real appreciates. The dollar depreciates, and the real appreciates. Now, this ends up causing problems in the emerging nations in general, Brazil in particular, but the emerging nations in general, where so much of the capital is being directed, because as the capital flows in, the currency appreciates, making it more difficult for these countries, which are primarily exporters, to export their products. So on one hand, they have the benefit of foreign capital. And the cost of capital has diminished, but on the other hand, their exporters are now facing more difficult terms to sell their product. The terms of trade have gone against them. So the central banks of the emerging nations look at this carry trade, love the capital, but don't like the exchange rate and trade implications. So what then happens is we're getting the beginning of interventions by those emerging nation central banks to keep or prevent their currencies from appreciating. For example, with the real, if this is the private demand for the real and this is the private supply for real, what has occurred is the financial leveragers have added to demand, shifting the demand curve, and it causes the price of the real and the foreign exchange market to rise. Now, if the central bank doesn't care for this, and they obviously don't, and certainly it's not just Brazil, it's certainly the issue is the same with China and the countries they compete with. They're trying to prevent their currency from rising. And the way we discussed, and the usual way for them to offset that, is if this is the balance sheet of the central bank of Brazil, what they do is print currency and go into the foreign exchange market and buy dollars. And basically their balance sheet expands, and from a market perspective, by printing currency and going to the foreign exchange market and selling it, they shift the supply curve over from S1 to S2, and you end up with a new equilibrium at a lower price. So what they do is supply real into the foreign exchange market to offset the increase in the price, to offset the increase in the terms of trade, so that Brazil could have, and all of these other countries could have their cake and eat it too, in the sense of having inflows of capital, but at the same time not having the terms of trade work against them. Now, what this ends up doing is it now suddenly creates a new reason to exit the carry trade, or another reason where the bubble of financial prices could well end up going into a bust. And that is, if you're a hedge fund manager, you have borrowed in dollars, invested in the real, and then suddenly the central bank, and then in assets in the real, and then suddenly the central bank is pushing the value of the real downward and the dollar upward. Now, when you unwind that trade, it becomes more expensive to pay the dollars off. You borrowed in dollars, and now dollars are becoming more expensive relative to the real. So what the central banks are doing effectively is squeezing the profitability of the carry trade. And if this happens and becomes generalized across the world, what we then have is a situation where the hedge fund managers start to collapse the carry trade. The problem with the collapsing of the carry trade is it's not something if one or two hedge fund managers do it and they can get ahead of the crowd, which they're all presume they're going to be able to do. But what happens is most of the trades are packed into the same trade. So that if one or two or three start to unwind the trade, i.e. sell the Brazilian positions for the real, then sell the real back to the dollar, then the dollar starts to appreciate, and suddenly it's a stampede to unwind the trade. And so many of them are in exactly the same trade. So you go from boom to bust overnight. Not unlike the financial boom that we had in residential mortgage-backed securities, where on August 3rd, all of a sudden one day, out of the clear blue sky, there were nothing but sellers and no buyers, and a totally locked up market. And that's the mechanism by which a boom can result in the financial bust. So it's not just the United States central bank pushing, basically, easy money in the United States is pushing capital across the world. And it's causing the central banks elsewhere to protect themselves from a loss of trade, which has the potential of melting down the carry trade.